none of this is financial advice in terms of like, but USDC versus USDT or what has happened here. This is, all my personal views here in that I'm sharing.
What a weird weekend, huh? We've had a bank collapse, a USDC depeg, and Chelsea win a match finally, 3 matches in a row. You as an Arsenal fan will be very disappointed, but that's not the main news we have, right, Prashanth?
I'm not disappointed, man, with that last bit of news. I'm just worried that you're picking up form before you come play us next month. So that's my only worry.
But Arsenal still top of the league. That's surprising. But the big news is Silicon Valley Bank stopped all deposits. I don't really know. That's why I have the TradFi bro, the big brain VC here. I'm filling in for Raghu here, who's somewhere above the Atlantic Ocean, I think, flying from New York to Dubai. So yeah, what's happening with the market right now, Prashanth? What's happening with these banks?
See, again, before we understand what's happened with Silicon Valley, I guess it's just I think it's good for us to do some basics like 101, right? So every bank has its very standard business model, or at least it should, right? Where it takes in deposits, which is its liability, and then these deposits is what they kind of lend out and build asset book, right? And typically you lend out at X, you borrow or get deposits at Y, and X minus Y is your net interest margin on which you kind of seek your profits and like operating expenses, etc. Now, what happened post 2018, and especially after COVID, is that most of these banks, Silvergate, Silicon Valley, Signature, etc., they all started getting excess lot of deposits into their banks, right? And the deposit base of each of these banks just ballooned. And
where did these deposits come from? Did these come from a specific kind of customer?
Yeah, so Silicon Valley has been like the go-to bank for, as the name suggests, Silicon Valley, right? So a lot of tech startups and startups in general have been used to banking with Silicon Valley Bank. And so a lot of capital that they got in or deposits is from, a lot of the startups. And as you know, startups raised crazy amounts in the last few years. And they raise it from the VCs and it gets deposited into SVB, right? So their deposit base actually increased much more than a lot of other banks. So what happens is now you have a lot of deposits on which you need to pay some interest. And then, of course, there is demand for loans, which is where you kind of make your money, right? So when the loan book does not scale as fast as the deposit book, then you're with a lot more deposits than assets that you're earning interest on. And what do? You then try to invest this into securities such as bonds or stocks or whatever it is, right? To kind of earn that extra interest income. And this is where it gets very interesting for Silicon Valley Bank, especially because when it comes to the US, the banks, when they have excess deposits, they can buy securities. And you also have an option to categorize them as either a hold to maturity asset or an available for sale asset. And this is probably the first point that we need to quickly touch upon. And this is more of an accounting thing. And what the Fed has done overnight is effectively to kind of counter what they had originally done on the accounting side with these two categorizations. So hold to maturity means it's like a fixed deposit now that you and I must have at a bank, regardless of where the interest rates are. The fixed deposit, if you put in 100, is worth 100. You don't really mark to market and you take any losses on that, right? It is what it is, regardless of where the interest rates are in the market. So that's a hold to maturity book. Then available for sale is basically whatever you categorize as being ready for sale. Now, funnily enough, this should be marked to market, and I'll come to what that means. But it's not been done by SVB, etc. Because of, again, how the accounting process works. So even though it's reflected a bit on the capital and equity side, it's not really taken as an immediate loss on a month to month or quarter to quarter basis when the books are marked. So what has happened is they are holding like tens of billions of assets across hold to maturity and available for sale books. which the interest that they're earning on is anywhere in the 1 to 1.5% region, because these were all bought over more than a year ago when the Fed had not started hiking rates. And now these same type of maturity bonds in the market are priced at around 4 to 5%. So
It's a
effectively,
huge
if you
cost
mark
for
this,
them.
it's a huge cost. It's basically, if this is a trading book, then all of these would have been marked down to a significant loss. Okay. And all these numbers are available and they have been disclosing the. Look, again, it's not like this has something happened overnight where people are suddenly woken up and, oh my God, there is so much unrealized loss. No, they have been reporting this every quarter ever since they started building these books. But because accounting allows them to keep it, at maturity value without, at par value without taking losses, they have not taken losses, right? So this is the first main point to address, that accounting has been an issue in terms of how these assets have been categorized. Now, second is, even though you have these assets, the rates are increasing. What typically banks or trading desks do is they hedge out their interest rate risks. What that means is, if I have taken a bond at 1.5%, if I expect the rates to increase tomorrow, then I swap my fixed rates to a floating rate through interest rate swaps, which are extremely liquid. So if they had done that, then as the rates went higher, their bond book would have taken a loss, but their interest rate swaps would have shown a profit of an almost equal amount, right? And then that's effectively what hedging is. So you would not have any unrealized losses. But again, if you are sitting in the risk management unit of these banks, then you're probably thinking, hey, this is a hold to maturity. I don't have to take a loss anyways. So why do I bother taking on a hedging risk anyways, right? But in retrospect, it's probably not appropriate risk management, right? Now, that is the second point. Now, the third point is what happened in the last 6 to 9 months is that two things. One is tech and crypto started facing a lot of headwinds, right? Especially from the time that FTX happened. And again, Silicon Valley Bank is not a crypto bank, right? It's a
But they serve a
tech-focused
bunch
bank,
of
of course.
crypto companies.
Exactly. They serve a bunch of crypto companies, but it's not like a Silvergate or a Signature whose core business is crypto, right? SVB's more core business is tech. But tech has also had a fair bit of pullback in the last couple of quarters. So what has happened is the third point specific to Silicon Valley is once they deposits started receding on their side, and deposits are receding because tech companies probably started pulling out deposits to either address their own liquidity issues, or a lot of these banks are not paying sufficient deposit interest rates. They are still under 1%, when the 2-year treasury is like at 4 to 5%, right? So a lot of people started withdrawing these deposits to directly put it into money market funds like treasuries to get those higher interest rates. Regardless, deposit base started coming down. And when deposit bases start coming down, then you have to start paying these deposits from somewhere, right? And in the process, I guess they started selling out of their accounting for sale book. Okay. Now, once you sell something out of it, the market will not buy this at par, even if you have marked it at par, right? So they had to pay the market value of it, and you therefore have to crystallize a significant loss. When you crystallize such a loss, then your capital ratios get hit, and of course your liquidity also gets hit, right? So then they wanted to raise in the market, and when they put out raising, even until now, it's not a problem in my opinion, right? And the reason for that is General Atlantic, one of their investors, had already committed to putting in 500 million out of the roughly 2 billion that they were raising. So they had an anchor investor as well. But what went against them is two things. One is Silvergate did this, voluntary liquidation announcement on the same day that they made the funds raise announcement. And Founders Fund, which is Peter Thiel's fund, they alarmed a lot of their portfolio companies, telling them to pull money out of SVB, right? And these two created a massive domino effect, whereby a classic bank run happened on SVB, right? So if you have to summarize, it's like 3 points, right? One is accounting, two is risk management on interest rate swaps, and three is just the timing of Silvergate's announcement and Founders Fund asking its portfolio companies to pull out of SVB. So these three just pretty much created a massive effect. It's not happened overnight, because accounting has been in place and their disclosures have also been in place. So this has been building over a period of time, it just fell over the cliff because of these two events that happened on the same day. So I wouldn't call it technically a solvency issue. It's more of a liquidity and timing issue.
And okay, how much of this is due to the fact that, okay, you mentioned a couple of parts of the puzzle right here. The interest rates that the Fed fairly decreased then increased since COVID. And over the past few years, at least 6 months to a year, there have been increasing interest rates, which makes investing in anything risky like crypto or tech-focused companies even more risky, given the other case, the sort of short-term borrowings are fairly, better performing than the rest. And then there's also been a significant slowdown. At least two things that I'm seeing here is that there's been a significant slowdown in VC funding for both crypto companies as well as tech companies. So there's not a lot of money for these companies to be put into Silicon Valley Bank, which is their assets at the end of the day. The second is you're seeing this in headlines like this company laid off so many people, this much percentage of workforce is gone. Coinbase did that, Polygon did that. Do you think that frightened, say, other people to say not invest money into tech-focused, crypto-focused companies? And does that lead to, say, banks that serve these customer bases not receive any assets and prop up their books? Is that like a larger play here?
See, I mean, it is definitely a factor in the sense that crypto and tech, VC-based funding has reduced. But again, this is a downward trajectory from Q1 of 2022, right? So again, this is something that has been happening for a year now. Silicon Valley Bank has been in existence for 40 years. This is not the first cycle that they have seen of VC funding retracting from the space. They have seen many more. In fact, they had a massive pullback even in 2003-4, right? When post.com, I guess. So they're not new to this. But we do live in like a very strange world, and all of this goes back to the period between 2008 and 2021, where rates were kept at like significantly, close to zero all the time, and massive amounts of money printing happened, and deposit rates were not increased, right? Even though Fed funds rates are like close to 5% now. And that is, I think, one big problem that a lot of these banks are not problem, but one thing they have not done is increase the deposit rate. So if I'm keeping 10 million at your bank, I'm only earning like 1%, but I know I can take it out and put it in treasuries at 4%. It's a no-brainer. I would do it, right? They could not, however, match the 4 or 5% they're getting outside, because if you go from 1 to 4% in like 3 months, then your entire profit margin goes away, right? And it's a very difficult call for a bank to take. And also there is an element of greed as well, that I have excess deposits. Why do I have to pay them anyways? Because I don't need any more deposits. So I think these are like two very two characteristics that has caused this. Now, I think VC funding on the back of all of this it was already on the downward trajectory. I don't expect it to go back up significantly anytime soon. Plus, the era of cheap money is also over, right? Now the Fed fund rates is around 5%. So cost of borrowing, right from the mothership, which is the Fed, all the way down to VCs and like startups, has also increased now. So it's not that you can keep pumping money into the ecosystems anytime soon. Now, again, famous last words. Now, I don't know what the Fed will do out of this. I have a hunch, but let's come to that later. But that's pretty much my take on VC funding.
Okay, so now let's say you speak to a lot of founders, Indian and global, right? And they're alarmed by this. They don't know what the hell to do. Some of them might even have funds on Silicon Valley banks or other American banks that are affected by this. If they come to you for advice and ask them, hey Prashanth, what do I do right now? What are you going to tell them?
Oh. Yeah, I mean, look, we do have a portfolio of companies, right? And we do speak to them all the time. We have been staying close to them over the last week, especially over the weekend as well. And this is not an easy thing to answer, okay? And I'll tell you why. So right now, most of the banking globally and also the startup funding happens in either USD or in stablecoins. Stablecoins also that companies mostly hold is USDC or USDT, right? And there has been a progressive move towards USDC because USDT has not done an audit that people could sufficiently rely upon. So it's USD or USDC. Now, when it comes to USD, there were like not many banks in the US that were opening up bank accounts for crypto-based companies, right? The ones that were there were Silvergate, Signature, and SVB. And in a weekend, all three are gone, right? Now there are smaller banks that you go to, but then structurally, how much do you rely upon them, right? They may have the same hold to maturity and available for sale asset problems. They may be a lot more disincentivized to open accounts for crypto based companies. And if they all perceive that Fed is anti crypto, now again I'm not saying they are, but if that is a perception that these banks have, then they will struggle, right, to be very pro crypto in such a dicey macro environment. So what that leaves us with is then more stable coins, right? And right now, funnily enough, 24 hours back, my theory would have been very different, but right now it feels like USDC is very strong from that overall standpoint, because it's diversified across, was 8 banks, now it's 7 banks, and all of its non-bank assets are kept in very short-term treasury bills, right? So very, very low exposure to interest rates and high liquidity as well. So they have done all of the diversification at their end that you as a company, as a fund, or as a startup don't have to do at this point. So in a way, it looks like USDC could be a winner out of this entire discussion, right? But it's not easy for startups because, like I said, liquidity gets tighter, and banking access, especially in the US, I think becomes more and more difficult, right? So USDC as a rail appears to be open, and that is probably where I guess immediately people will start to focus on. And there are a lot of smaller banks in US and also in Europe that also take USD based deposits. And there is a list of that as well. And that is also something, startups will have to speak to. And that is something we are openly making intros to. And where we don't have intros, we are trying to seek those intros to make them for these, for our portfolio companies as well.
It's funny that you say USDC is stronger now after what has happened. Anyway, by the way, we're recording this on the 13th of March in the morning at about 11:30, right? And 48 hours ago,
11:30 IST. 11:30 IST. I think
11:30 Indian Standard Time. 48 hours ago, USDC went down to about 0.88 to the dollar. So it's lost its peg by about 12%. Every stable coin apart from USDT was trading at a discount to the dollar. Right now, it's back for a couple of reasons, and I want to get into that because that was a huge story directly affecting a lot of retail crypto investors like myself and probably like you as well. So there was one tweet by Circle which said that roughly $3.3 billion of their 40 billion reserve was in Silicon Valley Bank, and that was locked indefinitely, at least over the weekend. But now we've got a little bit more clarity. And you mentioned that it's gone from 8 banks diversification back to 7. So across, of course, Silicon Valley is now out of the question. What does this mean for, say, the rest of the stable coins in the market, right? Because now we've seen a lot of issues with stable coins. UST went down, BUSD is now off the market. USDC has some problems, but you're completely contrarian here and saying that no, USDC is far stronger than the rest right now. The diversification is better. They're not exposed to interest rates. But what do the rest of the stable coins do right now?
Yeah, see, I mean, when you look at stablecoin ecosystem, there are probably 3 types, right? One is backed purely by USD, which is your USDC, BUSD, which was Paxos, and the similar ones, right? USDT also probably falls into this, but then, we don't know for sure what exactly backs USDT. And even if it does, probably it's around 80 to 85% backed, right? That's the amount of clarity we have received so far. The second type is the second type is your algorithmic stable coins, but I don't think anyone will take the risk of going into something algorithmic in such a volatile
something like
environment
UST.
at this point. Exactly, something like UST, right? And even if you look at Prax, which was a quasi-algorithmic stable coin, they've also moved into becoming fully collateralized now. So that is the second one. DAI is also like, almost 50% USDC. So I would say a lot of algorithmic based coins are also moving more into the collateralization zone. The third part is the non-USD stable coins like Euro, Yen, etc. See, of all of this, right now, the one with the maximum liquidity is USDC and USDT, right? Your collateralized stable coins outside of these two have lower, liquidity, not liquidity, but the overall, supply. And the non-USD based coins also have very, very low supply, right? So some people can probably go there, but those are not like scale solutions. Within scale solutions, it's USDC and USDT. Now, why I'm saying USDC is probably interesting at this point is they are also working with the Fed to open to cut out the jargon, to open an account directly at the Fed as well, right? What does that mean is they are then bypassing the entire banking system and making your USDC redeemable at a Fed level. So then it becomes not a banking risk, but a USD risk at that point, right? And that is probably something a lot more people will be more comfortable taking, especially in this environment.
So from
That's where
trusting a
that comes from.
bank, it would be trusting the government at large.
Correct. The Fed, the USD, the government. Yeah, exactly. And see, also, if you look at USDC, what happened over the weekend, right? So 3.3 billion, as you said, was around 8% of the funds. My gut feel was, there will be some sort of backstop on SVB because it is fairly decently big, top 20 bank, a lot of deposits, a lot of startups, etc., dependent on it, right? And business wise, it was still fairly healthy. So I thought it would be backstopped either by someone buying it or by the Fed backstopping it in some shape or form. And even if that got delayed, right? Typically, what happens in terms of claims processing is the first 250K gets paid. And then, if you look at the historical precedents, 50% of the uninsured deposits also get paid fairly quickly within a week. And then after that, everything comes down to what type of assets they have and how long it takes to sell it off. And even when that happens, the claim on those proceeds is fairly senior for your depositors. They get paid out first. The ones who take the hit are primarily your bond holders and your equity holders, right? That's pretty much how the waterfall works. So looking at the balance sheet, it felt to me that, okay, the worst case is that this entire payout will be delayed. And maybe there'll be like a 5 to 10% hit on the 3.3 billion. But given how much interest USDC and Circle earns as a business, it would be covered within 6 months. So it was not like terrible issue, right? In my mind, at least, purely based on just SVB as a bank. So that's why I was fairly okay with USDC regardless of what was happening. And now I'm thinking, with that kind of gone out of the way, it's probably come out a lot stronger. I cannot put my hand on heart and tell people to go into USDT at this point because we don't know what is backing USDT, right? And it might just be and they did come out with a post saying that we have no exposure to Signature Bank, and they also I think put out a post saying they have no exposure to SVB as well. So now then the question is like, who exactly are they banking with, right? So that's a different beast. So that's my take on USDC.
Over the weekend, I spoke to a few crypto traders who were playing it long on USDC, right? They felt the exact same thing like you did, but they sort of bet on the fact that USDC would go back to parity, and it did. They probably made a good chunk because like 12% down, 12% up, going down, going up was pretty good on them. So if this is something that can't sort of bring down USDC, a potential banking partner that went down. Again, it's only 8% of their reserves. Is there anything that can?
What, bring down USDC?
DC, DT, okay, there's a lot of shady stuff going on.
Still they have diversification across 7 banks and short-term US Treasury bills, right? So the next risk is then the 7 banks at this point. But effectively, what the Fed has done is it has pretty much come out with this 25 billion fund, right? And they are saying that we will be backstopping any other banks that go into any of these risks that the SVB etc. have gone into. So even these 7 banks, because they're a depositor, if some sort of a bank run happens on them, then technically the Fed is going to backstop it because they have committed to it, right? So that risk to me is fairly remote now. Then their other part of assets is US Treasuries, which is again very short term. I think maximum is 6 months. So that is also very, very liquid, right? There will be some sort of market risk, but I don't think that will be significant anyways. So I don't see any massive risk vectors around USDC. Now, unless, of course, the business itself has done some unscrupulous things like, what we have been seeing in the last 12 months. But, that is then then I'm entering into a land of speculation, which I don't want to at that point. Yeah. So this brings me to like what Fed has done overnight, right? So they have come out with this, I forget what it is called now. It's some bank, not term bank funding, right? Fund, something of that sort. Anyways, what they're trying to do is this entire hold to maturity and available for sale assets I mentioned right now. A lot of US banks hold such assets on their books, and what it means is that a lot of them are therefore exposed to a lot of crystallized but unrealized losses, right, on their balance sheet based on mark to markets. So what the Fed is now saying effectively is that, hey, you can go around and look at all of these banks and spook yourself out, but realize that we are backstopping all of these banks' deposits. At least the way we are doing this is we are telling these banks that if you need any sort of liquidity, then deposit these assets with us. We will give you, a loan on those assets by assuming these are priced at par, and you will have to pay like an overnight interest rate, which is okay at around, I think, 4 to 5%, as opposed to the 1% that you will be earning on these assets. But I'm pretty much backstopping your entire hold to maturity and available for sale book, right? So now, therefore, there is no point going around and like looking at other banks as to who is holding what type of unrealized losses, right? So when I started this entire discussion saying that the accounting is probably what started this entire cycle, so now Fed has kind of countered that entire accounting narrative by backstopping these assets.
Okay, that makes that comes at least for full circle there. But like, at least in the crypto world, right? The people who aren't who don't come in from the traditional finance world, they give the Fed a lot of shit. They're like, oh, these people are just coming in and doing bailouts. We started with a bailout, we're going back to a bailout. But this is this a bailout for the bank? And if it is, right, how does it actually help or affect the tech founders, tech companies that are banking with either Silicon Valley Bank or other banks?
See, I mean, having been through 2008, 2009, that entire cycle, bailout to me means something quite different, right? Bailout is where you bail out the equity holders, and you are effectively keeping the entire institute intact as well, right? And what they did with, say, AIG, or what they had done with some of these other banks as well. And bailout is basically when you protect the junior equity holders, right? In this case, it's more of a backstop. Okay. And because they are only gone up to say that there are this pool of assets that have unrealized losses, but we are backstopping them and we are willing to accept them as collateral if any bank wants to borrow from us, right? So at this point, at least, it feels more like a backstop, less as a bailout, right? Now, what the reason also why they may be doing this is a lot of, especially if you look at Silicon Valley Bank, right? Their almost entire client base is startups and your small and medium term businesses, right? Who are in need of a lot of this cash to keep their payroll going and to operate as a going concern. So that is why this backstop is coming in my opinion, to kind of keep these businesses running, right? And they're technically not bailed out either SVB or Signature, because Signature, again, it's a black box. I don't know why they did what they did, but SVB especially, they're not technically bailed it out, right? Because the company has been taken into receivership, so there is no coming out of that and operating again as an SVB at this point. So therefore, it's not been bailed out. And no, this backstop is more about the other thing about bailout is it usually uses taxpayers' money, right? In any bailout that happens. Here, effectively, Fed is it's again more of an accounting treatment that they are doing between the Fed and these banks to backstop it and make sure that they don't face any sort of liquidity issues, right? So again, it's not in the traditional terms, it's not bailout. Now, I don't know what kind of contagion will come out of this. Not sure. I think this will probably blow out in the next week or so, because the Fed has backstopped it. But the market seems to feel that this is more of a traditional bailout, and the Fed will start now pumping more, printing more money and reduce rates again. That I'm not very sure about that the Fed will do.
But if that happens, then it leads back to the same cycle where there's cheap money in the economy. People will start investing in tech companies and crypto companies. The yields in all DeFi protocols will go back to like triple digits and stuff. And then we're back
Oh
to
my
square
God,
one.
yeah. Yeah,
So,
it is back to square one. Of course, a lot of people on Twitter, especially, really want this to happen. Of course, selfishly for their bags. So, I don't think it's a good thing, because that structurally does not help the common man. And you do that, and inflation again starts peaking, right? And that is, in my opinion, a very bad outcome, because then you don't know how it manifests itself into a two-tiered society, and what type of civil unrest that generates, because anything like that happening will again just put more money into the rich people's hands, right? So and end of the day. So yeah, I'm not a big fan of that, but I'm not the Fed, so we'll just have to see what they do, and then position ourselves accordingly.
Yeah. Oh, the one thing that people on Twitter were positioning themselves with is like, this makes the case for Bitcoin all the more stronger. And because all the swaps were happening on Ethereum, or at least the blockchain, right? When they were swapping USDC for USDT, people are like, oh, Ethereum is now stronger as well. So do you buy that? Or you're like, that's just a short-term thing, man. You got to like look at the big picture here.
See, I mean, in my opinion, between Ethereum and Bitcoin, I think Ethereum has a lot more utility because of the ecosystem it has, and the transaction that it kind of facilitates on a
In
daily
situations
basis.
like these?
No, in general. See, this situation is not about a Bitcoin versus Ethereum. It tells me that how much we are still dependent on traditional banking, and how much we are dependent on stable coins, which is effectively USD. And have we taken a step back to realize that, why are we in this space in trying to create like a disruptive, newer, type of financial system, right? And that is more code driven and less intermediary driven. And what last few days has kind of told me, and I mean, I've always believed in that anyways, is that we are still way too dependent on centralized currencies and financial institutes, whether we like it or not. And there is no point kind of taking a moral high ground and saying that one is better than the other, and we just have to embrace the reality and work around it. But yeah, I mean, I don't think this is a Bitcoin versus Ethereum discussion at all right now.
Okay. So don't listen to the noise on Twitter, because everybody was just yelling at that, oh, Bitcoin's stronger than this. But
Yeah, that's another problem, right now. Something like Twitter makes money and information accessible. Sorry, between Twitter and on chain, you have no money accessible 24/7. Okay, but banking does not work that way. So a lot of usually weekends would be very silent, right? But this weekend was crazy, and I mean, I don't know if it's a good thing or bad thing, but Twitter, I mean, I learn a lot, but I just feel that it just has way too much PTSD.
Yeah, weekends, like crypto just lives on the weekends, and banks close on the weekends, and this was like the intersection of both. The funny thing is, I saw a tweet by Dante Disparte, the guy who heads policy at Circle, and he said at the end of the tweet, he said that we will be smarter on Monday. So he was also like, guys, I know it's a big problem, my stable coin is depegging, but like we'll handle this on Monday. But thankfully it was all sorted before Monday.
Yeah.
And so now what happens now, right? Like, okay, for crypto, we can at least see that any crypto startup that is banking with SVB or any at-risk company, they're at risk, right? Stable coins have become stronger, at least USDC has. USDT still fairly untransparent. What do we sort of do right now?
When you say we, as in you mean
the crypto world, the crypto industry?
Yeah, see, I mean, crypto world, I think having spent so much time in London, I think I would love to use this phrase that we use, right? It's keep calm and carry on. And I think crypto, the entire Web3 ecosystem, I think needs a bit of that. Don't lose focus on, like, we still have to build so much, right? And let's focus more on that. I know this is an issue, and it's not like, I mean, a lot of people were genuinely worried this weekend because it were hitting the payrolls, etc. But let's. This is again one thing along the way, and we should not lose focus on what we are here to do, which is to build, which is to re-architect financial systems and other industries. And I think we have to work more and more closely with regulators, right? And I was at this event on Saturday in Delhi, Namaste Web3, and was on a panel with regulators there, right, from Niti Aayog, etc. And it's we are still so dependent on traditional systems that and we don't control that, right? That control of all of that is with regulators, and it behooves us to work closer with them and come to like a common conclusion, which in my mind is, regulate more of the centralized intermediaries and let the decentralized world, find its path on its own through innovation, right? I think that is what we should be working towards on that side, and just keep building. Don't let the noise affect you in terms of, and don't worry too much about price action, etc. either, where Bitcoin goes, where Ethereum goes, etc. I think we just have to stick to what we need to build.
So one thing I also want to touch upon is like Coinbase, right? So Coinbase is, I think they're an issuer or a backer, or they have something to do with the back end of USDC, right? Along with Circle. And they put out a tweet saying we're going to stop USD and USDC conversions. And they hold a ton of USDC on their balance sheet as well, and cash, like in US dollars. Could at any point, could they have come in and said that, hey guys, like, let's stop this bank run on, at least could they have come in and sort of support the peg of USDC if the situation would arise?
Yeah, so yes, Coinbase in some shape or form is involved with USDC. I'm not fully sure how. I think the day-to-day thing is managed by Circle, but Coinbase has some relationship, right? So I'm not exactly privy to that part. Now, specific to USD to USDC that Coinbase stopped, I think that was more to do with banking not being available over the weekend, and them not wanting to process too many of these requests at their end, and having to then backlog all of them for the start of the week. So and I think this is probably the main reason why they did that. Now I'm almost certain that given their exposure to USDC and also their close relationship with Circle, they must have been working in the backend on trying to help Circle and USDC resolve this. But yeah, I guess we can't say that anything for certain, because we didn't see them putting out anything, or at least I missed anything of that sort, right? Now Coinbase is now turning out to be one of the places where people are withdrawing their USDs into as well, and they could become like a very good conduit for this entire USD to USDC going forward. And it probably just solidifies their position from a crypto ecosystem standpoint.
Of course, none of this is financial advice, or a disclaimer has to be mentioned, right? So
yes, I have to actually none of this is financial advice in terms of but USDC versus USDT or what has happened here. This is all my personal views here in that I'm sharing with Akshay and the team. So yeah, don't construe anything as legal, tax, financial advice.
all right, cool. Cool. So let's just run through a quick TLDR of what exactly happened, so that we're on the up and up. Right. So in 2020, again, like, I'm going to butcher this, and Prashanth, you're the TradFi guy here, so you can like correct me here, right? Whenever I've missed out. So in 2020, rates were incredibly low because of COVID. So people wanted us, at least the government wanted people to spend like crazy. So like home loans were very low, everything else was very low, right? So it's cheap money. I could borrow, I could put it in whatever the hell I wanted to. And the price of a lot of cryptos and the tokens at a lot of DeFi protocols just went up and up and up because of that, or one of the reasons because of that. And that eventually lasted for a period of roughly 2 to 3 years, until, say, Luna and Celsius and FTX collapsed. Not because of that, but because the rate started increasing and people started pulling back their money into their own sort of into something safer, something like T-bills, or something like government bonds, corporate bonds, etc. And they started pulling money out of the places where they stored it, whether it's crypto exchanges for crypto investors or banks for tech founders, and VC funding sort of dried up, and it will probably continue to dry up. And that's what led to at least SVB sort of getting a hit. But Silvergate was also a bank for various crypto exchanges. People started pulling money out of crypto exchanges. So there was a big problem there as well. Now eventually led to USDC, which was Circle, which was one of the depositors with USDC, or with SVB. And their money got stuck, and they sort of couldn't pull it out. But again, everything sort of ended up fine because they pulled their money into another bank, I think. So is that like a fair summary, or is there anything else that you have to add? I know I didn't get the accounting aspect of this. That went over my head, but we can break it down in the newsletter for sure.
Yeah. I mean, I wouldn't say it's 2020. I think these things have been building up since 2008. right? And it's just 2020 just accelerated everything significantly. And what we are seeing now to an extent is the outcome of liquidity starting to get squeezed out of the system, right, through increased rates and quantitative tightening. And in a way, look, it's also market forces playing a very free hand, to the extent that these banks did not increase their deposit rates, so people started pulling money out and putting it more into like treasuries, and that started you can say that was greedy, that was like of these banks, or you can say they have just had too much funds, whichever way you look at it. But market forces started playing there, right? Ultimately, what matters, not what matters, but then what is important is that it is the Fed's market. As long as you are dependent on USD, it is pretty much the market is being set by the Fed. They and I don't think they always do a very good job. They kept rates too low for too long, and then they started hiking it aggressively. And then also, even 2 months back, they were like, the market was going up in a frenzy, and they did not even do much to kind of pull it back. And last month they again sounded like more hawkish again. And now I don't know what they will do on March 22nd, right? But it's there is
Wait,
a lot of
what's happening
volatility that
on
is.
March 22nd?
So March 22nd is the next FOM, Fed rates meeting. When we know whether, the market was thinking after the last meeting that there is a higher probability of a 50 basis points hike. Now that has completely gone up. Now people are expecting more of a 25 basis points hike. And, in fact, a lot of people are now swinging the other way, saying that they may not hike at all. I think Goldman Sachs just put a report out saying that they will not, they don't expect the Fed to hike at all. So yeah, man, there's a lot of volatility that's also created because I think even though it is the Fed's market, I don't think they have done the best they could in the last 15 years in terms of how they could have managed the economy either, right? Now, again, it's easy for me to sit here and say that they have a very tough job out there. But yeah, I mean, in retrospect, it's yeah, anyone can, make an opinion.
Damn, yeah, they have a huge job there. And it's affecting us as stablecoin users as well. My God, but this was crazy. I learned a lot, and I hope our listeners, readers did as well. But yeah, that was the wrap up on whatever happened over the past 72 hours in crypto, in TradFi, in banking, in my portfolio, in every single thing. I'll catch you guys next time.
Yep, and get some sleep, guys, everyone.